miners, welcome to another yarn brought to you by Axis Mining Technology. GC, you know better than anyone, the trusted advisor in drill hole survey instrumentation.
Absolutely.
Champ Ori, Champ Gyro, bloody beautiful. Hit them up for that discount too. Mention money of mine. Free trial for a couple of weeks. Lovely. What do we got today, team? Bit of a quarterly around the grounds, GC.
Bit of a around the grounds. I'm doing a bit of a tour to gold in honour of the Tour de France going at the moment. So bit of around the grounds there.
Oh, I love you. Bloody good to have you on board. JD, what do you got? Bit of Sandfire, mate.
Bit of Sandfire, bit of Karoon as well. I think that's the most interesting one, at least of the ones I'm chatting about, spin my wheels. They have put in place, on the back of the quarterly coming out as well, a capital allocation framework. One of the most exciting things we talk about.
Sensational.
Genuinely exciting news, though. We'll get into it later.
Righto, GC, get into it, mate. Hold on. I'll just have this come up on my screen.
What's that?
2 secs. What? Bellevue raising capital.
No.
That just come. I just noticed it. You got to be kidding me.
Just come across the wires, has it?
Something that I was told would never happen. Bloody hell. Anyway, well, we better. Is it all right if I do that first?
Yeah, you go
instead?
for it, mate.
Righto, cheers for that. I'll just go through it. The green gold producer raising $150 million via an insto placement and $25 via a share purchase plan at $1.55. So 15.3% discount to the last close at $1.83. So the purpose is I'm just reading as I go here. A big chunk of the money is planned to pay off $120 off the Macquarie facility. So that's going to leave around $100 of debt. You saw the old short interest spike back up. Bloody look at old short man here, up around 6%. So they're T+4 numbers. So I'll be very interested to know. Check it in a few days' time what the short interest was as of yesterday. So probably a few happy shorters out there.
Yeah, it looks like
probably some unhappy longers.
Absolutely. It looks like 18-odd million closed out their shorts just a couple of days ago. So we wonder.
Yeah. So
they'll be kicking themselves.
Well, if you look at let's just call it for what it is. So they raised $106 at 85 cents back in 2021 and had that $200 debt facility in place. August 23, they obtained an additional $25 debt facility from Macquarie as well. So I
believe it's all fully funded.
Fully funded, yeah. But look, I guess the share price is really good gold price, so that's been good for the share price, hovering around bloody $1.82 for the past few months. So I guess that debt facility, coupled with the perception they're never going to raise and they want the execution re-rate, they've effectively raised $175 at $1.55 instead of equity funded. So a lot less dilutionary if they majority equity funded back in the day. So it's probably all worked out beautifully for them.
Couldn't agree more. Couldn't agree more.
Yeah. So it's probably the least dilutionary way of doing it, but it wasn't what was guided. So, my interpretation, or they were under a lot of pressure operationally to service this debt going forward, but
pressure from multiple faces, which I'm sure we'll get into.
I'll get into that later. So still stuck with the hedges, but that come with the debt. I'm not sure if there will be any that'll be modified or added onto if they restructure this bit with Macquarie, but I assume they all stay in place. So a bit under. Fucking software update, go away. So bit under half of the hedged ounces for this financial year have been locked in between 3,500 to 3,900 with some, what do they call them? Bloody zero cost collars. So, but still 220, if you take them away, 227,000 ounces and an average of $2,800 an ounce hedged going forward. So take away the zero cost collars, about $160 out of the money at today's price. So, I'd reckon giving away those 53 ounces at 2,700 in 2027 if we see gold keep rising will be a bit bloody painful. So
could be worse though. Not impossible to make money at that price.
Yeah,
so it's no Calidus.
Yeah, definitely. So same debt provider.
Well, we'll get into that.
We'll get into that.
They've the way they've wrapped this around, they've obviously seen how well you get rated for a long-term growth story like Genesis and Orabanda. So Bellevue is now a growth story heading out to FY28. So guiding for FY25, 165 to 180,000 ounces at an all-in sustaining cost of 1,800. So if you go back at how much has changed, there's inflation. I think there's been a bit of extra costs incurred as well, but the 2021 stage 2 PFS was 200,000 ounces a year for the first 5 years at $922 an ounce, all in sustaining. So
double.
And like you pointed out earlier, Matty, that 1,800 isn't a direct comparison to the 920 you're saying there. That's the FY25. So that should come down. The average for the first 5 years should be a bit lower, but still.
They're saying for FY28 onwards, when they get up to 250,000 ounces at 1.6 million tonne per annum, it'll drop it to around 1,500.
Yeah.
Anticipated. So where's this money going? There's the debt, but they're talking about this a lot about exploration, a lot about unlocking the future value of the asset. They're developing 3 exploration drill drives. That's what they say, but these exploration drill drives are the declines to access these other ore bodies, the Viago, Deakin North, and Southern Bell. So they're effectively bringing that capital development forward to few. There's obviously shitloads of gaps there. They're going to if they drill, they will more than likely find more. But they're not exploration drill drives; they're the actual declines. So it's and they go, as I said, going to commence expanding the mill to 1.6 million tonne per annum from the current 1 million tonne per annum by FY27. So, which is actually not that hard for them because they oversized the crusher and everything like that because I think they were just going to crush on day shift on the renewables. And so I think they're adding a few more leach tanks in, another thickener and another ball mill. So it's actually not
reasonably straightforward to get it.
Reasonably straightforward to expand it, not as straightforward to fill it. And because they have not proven yet that they can fill that mill for a year. I know it's in
at 1 million tonnes.
No.
Yeah.
And look, as we said, last month we saw they milled more than they mined. We've seen the capital development lift a lot, which indicated that, and I know that stoping is right up the arse of development there. And we've said it before, it's not the easiest mine to hit targets in. A lot of independent areas that need to be have independent infrastructure. Very hard ground, which really, and especially when you're in mining narrow vein, the time it takes to probably rip a stope out compared to getting the development that far ahead, like that, those jumbos need hard ground, can really slow everything down, especially in your decline and everything in your bigger headings. It just takes you longer to frickin' drill it. And they can't, they've got power constraints, like shitload. They've got a shitload of machinery down there with all the exploration rigs, all the raise bores, all the jumbos and everything, and the big renewable component they've got for the power supply. Like there's water constraints to run all the drills, because you got all the, as I said, all that machinery needs power and it all needs water too. So there's just a lot going on. But they've mentioned that they've got to upgrade the power for this whole thing, which they're going to need to, like an extra ball mill, 2 extra jumbos are coming. I think one was already planned. They're bringing another one in that's going to be dedicated to that Deakin North decline.
Yeah.
So all needs power, more fans to ventilate these areas. So that final power station is supposed to be they've got in their preso, it was 89.7 megawatt hybrid setup. they said they got the final wind and 7 megawatts of solar power expected during this half. So I'm actually not setting this up for a Silverstone ad. I'm being dead serious here about the power. But not much info on the power upgrade, but I'd be extremely surprised if it's going to be green power, if it's going to be more wind and more solar. I'd think to de-risk this project, they need a lot more bloody reliable,
stable
baseload power. So to come from that's the thermal station. So that's the diesel gas station. So that's about 24 megawatts of the 89.7. So the diesel's mostly, from what I know, is mostly used for the startup, like because when you start fans and start your ball mill like that, that's the big power spike. So that's what the diesel
to get things
capacity going. Is to get going. So the rest of it now, I'm pretty sure it'd have to be pretty sure they're hooked up to the gas line that goes up through that way. So it's probably been an absolute godsend that Mount Keith is getting shut down, because they'll be able to pinch some more LNG from what was going up to Mount Keith. So that's probably going to, because whether they would have had, because they're going to need to expand, put more gas sets in. I think that sets are the word, to actually expand to get more power for this, because there's a lot more going to be more going on. So you need more power, and if they're already constrained, so it'd be interesting to see. It'd be interesting to see if Zenith are the ones that wear the capital cost to expand it, or Bellevue, because Zenith, you'd say they're the ones that finance, built, and operate that power station under that power purchase agreement.
And own it.
Yeah. So I assume that they will wear the capital for it, and it's essentially not paying the capital but a higher power operating cost, because they'll be taking their bloody cut out of it. So, yeah, interesting to see what happens there. Now, here's the sneaky one on page 41. First pick I'll show you is the reserve estimates from the Bellevue website, and what we knew already. Total ore reserve, 6.8 million tonne at 6.1 grams, which contains a high-grade underground reserve of 4.5 million tonne at 7.9 grams. But if we look at today's ore reserve statement, the total ore reserve is now 9.3 million tonne at 5 grams, and the high-grade underground reserve is 6.83 at 6.1. So by the numbers, the previous total reserve is now equivalent to the total probable high-grade underground reserve, and there's another 2.5 million tonne that's been added in at 2.1 grams. So that,
and why would they do that, Matty?
Well, to fill this mill, you got to bring forward more low-grade material into the mine plan, which is obviously what has to happen.
So why don't they put this on page 41?
Oh, you wouldn't want to you don't want that on the front, do you, GC? Yeah, so let's look at what they're guiding to for FY25 now. So as I said, between 165 to 180,000 ounces, two scenarios I'll put through to you. If they're going to mine at that original 6.1, which is what they achieved last quarter, so obviously the dirt is there, for 165 to 180,000, that means they'll only put between 840,000 tonne and 918,000 tonne through the mill to achieve those targets. Or if they are bringing lower grade material in to fill the mill, that would mean the grade will drop to between 5.1 and 5.6. So it'd be interesting to see if they're going to fill it or not, or they're bringing more low grade on to actually fill it. So it's, where to from here is the question. So many questions. Because there's $315 going towards growth capital in the next 2 years as part of all this expansion. And so I would anticipate, based on because from where we saw things at the end of last quarter, thinking Stopen's right up the arse of development, still needing to get a lot of infrastructure in. That doesn't get. The only way to get capital development ahead with the power, the fixed amount of power and water you've got, is to slow production. That is the only way. Like, you cannot get more machinery to come in like that and get capital forward, because you need more power, more water, more vent, more everything. You can't and it just becomes less accretive the more machinery you get. So I would just to get everything back ahead so you've got a bit of a more sustainable runway. You have to slow production, and you have to put more trucks towards development to get the dirt out so you can cycle the headings. So I would anticipate the coming quarters won't be. Yeah, will be a bit challenging on the ounce front. But the story's changed. We're looking 2 years ahead now to FY28. So this raise has taken the focus off hitting those targets in the next quarters, and rightfully so. They should be focusing on getting the development ahead to have a more sustainable operation.
And that's where you're saying the majority of that 315 million over the next 2 years is, well, a lot of it, you get those 3 new development drives, but that's still a huge amount of capital.
And the power and the
power,
mill
of course,
upgrade,
yeah.
But that's I think they've got to have a bit over 100 of liquidity post the pro forma after they pay the debt, and we'll get into that because that's not a sure thing. But it's just they're under that much pressure at the moment. It's and you just want to make it more hectic by expanding it.
Does that 315 include getting them to 1.6?
Yeah, that's
the thing I don't understand, Matty, is with this, the placement component is 150 mil that they're doing, right? 120 of that is going to potentially, pay off debt. So if your assumption around free cash flow being sort of not massive in the next, say, year, they've got some cash now and the extra 30 mil left from the placement, and they want to spend 350 million of growth capex in the next 2 years. Is this raise actually enough?
Well, I think when I said free cash, that's including after that growth capital's going to get expended.
Oh, okay.
The actual free cash after that, I think is going to be, I can't see it being heaps.
Massive, yeah.
Because there's still got to be, whilst they're doing all this expansion, they've still got to be producing enough to generate a bit of free cash or even just break even to offset all the growth capital that's going in. So, I don't think they're completely out of the woodworks in the future if they're making a mine more hectic. So
absolutely. It's like you've sort of prolonged the Lassonde curve, a bit. You've pushed down the cash flows a little ways, although there should be hypothetically bigger cash flows in future years. But we're going to be talking about this in 2 years' time again, where we kind of thought we already were.
Yeah. And look at why it's happened, and it comes back to that yarn with Darko and Fisty that we had about how have they got themselves into this position? Because I believe that this raise isn't a part of a growth story. The raise is to get them out of the shit. With the debt and the pressure of it, because once
you wouldn't put that on the front of the slide deck.
once they had all that massive chunk of debt, the mill had to be turned on straight away to get the revenue, to keep the market happy and try and de-lever the balance sheet and everything. But when the pressure goes on to get all the ore out to bloody produce the gold bars to make the revenue, the focus may have gone off development and more onto production tons coming out of the hole, because you switch to full production mode, but it just hasn't. I don't think it's proven to be sustainable. So, as I said, lower ounces in the coming quarters won't have that much of an effect now, because it's right, we're looking to 250,000 ounces. The focus has shifted. So,
and the thing is, you can't. It's difficult to believe that they just happened on this 5-year growth strategy. This week.
Yeah.
With a capital raising during ramp up.
Yeah.
It's not a coincidence.
No. and look, it'd be interesting to know if on the back of Macquarie and Calidus, if there was, any pressure there, be like, we need you to take some risk off the table here. Don't know. But as I said, I don't think the pressure's not off. They still have to bloody produce enough to So here's another out there one.
Oh, God.
You like these ones? I reckon this raise is also, because, when we said M&A with Bellevue, it's like, nah, they got too much going on, got the debt, got to ramp up and execution. Well, this raise has definitely taken some pressure off that and might have put them in play for a bit of M&A, maybe.
Who do you think?
Well, what about a Bellevue Spartan Ramelius mega merger?
Merger.
Well, I reckon Bellevue would have been keen as hell to get Spartan, but they weren't in the position to. Unfortunately, now Ramelius have got their foot on there. But will something happen there? It's that could be a bloody. Yeah, I just don't think it'd happen. It'd have to be all three. Couldn't be Bellevue and Spartan with Ramelius there. I don't think they'll let that happen. They might. That could happen. Ramelius could maintain the bloody shareholding and keep their options open for the future. Who knows? But imagine that 600,000 ounce producer instead of being the risk of being a single asset producer. You never bloody know.
I mean, you could see, that the Ramelius Bellevue scenario could make sense. It's sort of, there's some hallmarks of the Red 5, Silver Lake thing here where, they need something to add to their growth story, Ramelius. They got a shit ton of cash. That they've got the balance sheet. Would they maybe do a Spartan style strategic investment, or just rapidly buy on market, post this race? Who knows? That it's not that far fetched.
No, and especially now they're in. I would imagine they're based on what's happened here. I think they're going to open. They're obviously going to open at $1.55, but will they keep going beyond that? Because what the market thought they were going to do and what they've actually done is very different. That can have a negative effect on prices.
Yeah, absolutely. I don't think they'll, kind of obviously open at 155. I think there's a good chance they open well below that.
Yeah.
If I had to guess,
Yeah, it'd be interesting to see, as you said, if someone starts picking some up GC on market.
I wouldn't be
strategic
surprised.
state. Looking at I even went in, Trav would be so proud of me. Even went into the fine print.
Good on you, Matty.
Interesting with the Macquarie, the debt side of things. And they did mention it up top, but it's more detailed in the fine print. I'll bring it up. So even though Macquarie are supportive of the debt being paid down to $100 million and restructuring to a back-ended principal payment in 2027, they still need to approve the life of mine plan, and if they end the actual restructure conditions. So if they don't agree, Macquarie can demand an immediate repayment of everything and terminate hedging contracts. So that's the joys of having debt. So not out of the woodworks until that is approved. So it's just interesting. So you got Macquarie with the debt. They got you by the balls a bit. You got someone else operating the power station. They're bloody. There's a lot of. I'd hate to not have control.
Parts.
Yeah. So.
But the thing with that, the proposed debt restructure, I'm not sure that it'd be in Macquarie's best interests. Just my opinion that they demand immediate repayment and everything, because I'm not sure, whether they'd be able to do that. Yeah, and look how that's turned out. So,
sure, it's not. It's just a risk. It's in the risk section for a reason. But that's the I'd be nervous having the debt with bloody Macquarie after what they've been through. But yeah, let's say that's obviously not over till the fat lady sings until you see that come through.
Yeah. Yep. We should flash up this slide that you got in here as well, Matty. So of that 315 to be spent over the next couple of years in CapEx, 210, at least 210 of it is development and infrastructure alone, and that doesn't include the plant. Yeah.
Oh yeah, I'll say yeah. Yeah. So a lot in like 60 mil into exploration, which is good to see. So there's it's just as I keep bloody harping on, but you got a mine to the ground, and it is bloody hard, and it just is one of those mines where sometimes obviously you just can't flick switches like that. You need to get the bloody capital in, and might take you 50% longer or twice as long to get it in compared to a normal operation with easy drilling. But that's it's how it is. That's the ground, and you need to get the mine set up so it flows, and no one's working on top of each other. It's easy.
You might see something like a red situation where the company the stock is in the doghouse for quite a while because they've just lost the trust with investors out there, and red got there eventually. They won people back over. They favourable gold price and everything. It took a long while, and they sort of turned the ship around. And I sort of envisage a pretty similar scenario for Bellevue here, where they need to prove themselves for quite a while.
Yeah, and it just I know we were talking about even though you got a really high grade mine, but when it's spread out like it can, the geometry of an operation can make things so challenging when it requires a lot of infrastructure, and they're just but now they want to expand it. So, jeez,
gold mining, hey?
Oh God, love it! Right, there we go. LEGC's Tour de Gold.
Tour de Gold.
I love it.
Got a bit of a French today. So we're going to go through 5 quarterlies today: Northern Star, Regis, WAF, Catalyst, and Pantoro. But before we get started, look at the share price performance in the last 6 months of these 5, right? Catalyst up 170 odd %.
Yeah, they're definitely flying under the radar, which is funny when you talk about management re-rates, like when you got the son of one of the most famous mining personalities going around out of Normandy. Yeah. But you look at what Catalyst are guiding to on figures, and very, very similar to Orabanda, even probably higher on ounces, but they're half the market cap.
I think they were flying really under the radar till about a month ago.
Yeah.
And then people kind of cottoned on once they sort of pre-reported some numbers.
Yeah, so I think they're good on them.
And then even Pantoro up over 100%, WAF up almost 50%. Gold, interestingly, over this period's up about 18%, and Northern Star up about 9%, and Regis down almost 20.
10 of that was today.
Yeah, and 10 of that was today. So it's just fascinating how these higher cost gold players and the African producers are just killing it compared to your sort of your blue chip or your standard Aussie producers. But let's get into it. So Northern Star, overall, pretty much everything across the board was in line with the guidance, with production, all-in sustaining and growth capex. They sold 439,000 odd ounces at an all-in sustaining of $1,815 Aussie, just scraped in within guidance on the production and all-in sustaining side. Underlying free cash flow of $462 million for the year, of which big chunk of that was actually this quarter, $189 million this quarter. So they're up to a cash and bullion of $1.2 billion, net cash of about $360 at 30 June. The Jundee grade lifted but was impacted by a bit of a mill fire, and Pogo had pretty outstanding quarter. Yeah, so a record 91,000 ounces, which is up from about 62,000 ounces in previous quarters. And
the grade really lifted there. I know they were talking a lot about, the control of dilution over there, because I think the ground's a bit challenging. I think different because they're in a bloody mountain. So when you haven't got when you're high up, you haven't got the sort of, I forget what it is, like there's no stress in the ground because you're above ground. So the ground's not being held together by stress. It's just fucking relaxed. So so looks, I didn't read too much into it, but a big good effort there. So
yeah, absolutely.
More ounces, and the all-in sustaining cost just comes right down.
Right down. They're 30% lower.
Yeah.
But for looking ahead to next financial year, they're guiding towards 1.65 to 1.8 million ounces of gold at an all-in sustaining of 1,850 to 2,100 Aussie, which is lower than what the street expected. They were probably expecting more around that higher end of the guidance.
But the all-in sustaining's up a lot higher.
And that's up a lot higher as well, along with the growth capex that they're guiding around $1 billion in growth capex at FY25 and an additional $500 million on the Super Pit mill expansion. And that is Northern Star. Moving on to the next stop on the tour.
Oh, the next stage of the tour.
The next stage of the tour.
Out to Wes.
Up to Wes. We've arrived at Regis. So they pre-released, but earlier in the month. So they produced about 106,000 ounces at an all-in sustaining of about $22.47 an ounce Aussie. And so overall for the year, 418,000 ounces at 22.86 Aussie an ounce, slightly at the lower end of guidance due to those rain events earlier this year. Generated $109 million of cash in the quarter, so they've got cash and bullion $295 million at the end of the year. So, and which they massively benefited from closing out that hedge book early in the year. And I mean, look at the chart today; they're off around I think 10% and that's pretty much in response to the FY25 guidance, which it is not a bit underwhelming on sort of all aspects. So they're looking to produce 350 to 380,000 ounces of gold, which is much lower than what they produced this year at a high all-in sustaining of 24.40 to 27.40 an ounce Aussie. Growth capital of 110 to 125 million. I'm unsure how that works because they're spending a lot of money to get a lower for a lower production profile. So I'm not sure how that works. And then, there's some exploration and McPhillamys costs as well.
Sounds like that 50 to 60 mil in exploration is very much needed.
Oh, absolutely.
Yeah.
And, they're sort of transitioning to an underground-centric operation at Duketon. So they're commencing development at Garden Well Main and they're also the Rosemont extension. And also just post-quarter end, they released a pretty underwhelming updated feasibility study for McPhillamys. And just to flag, McPhillamys reserves account for around 60% of Regis's reserves and 0% of production. And given the sort of the returns outlined in the study and the fact that FID is pushed out to FY26, it's becoming increasingly unlikely that this will get developed, at least in the very near term. So I don't understand how they're going to practically solve what is clearly a growth problem. They've got this lovely pathway to 500,000 ounce slide in their investor presentations. And even if you took the top end of the Duketon and the Tropicana numbers, which sum up to 400,000 ounces a year, where's this other 100,000 ounces a year going to come from? Because that's certainly not going to be from those two at this stage.
Yeah, I think a lot of you find more gold. You find gold where there is gold. So they've got to get that bloody drill bit spinning.
Absolutely.
To try and expand Duketon. Essentially, yeah. Gee, well, you've been deep in this today, GC. I've got a question regarding Duketon.
Yeah.
Let me just pull up the VRIFY model. Hold on.
Let's have a look.
REGIS. Oh, no result.
No VRIFY model.
No.
What?
Oh, I can't ask you the question then. It appears Regis aren't a VRIFY power user. We've found a new client in need for VRIFY. Mate, you want to grow Duketon, like you said they need to, GC. That VRIFY AI will tell them where to bloody drill. You want to make McPhillamys look better, you put it into a VRIFY model. It's
just as easy as that.
Yeah. Oh, mate, there's a bloody perfect case use there. Green at verify.com. There.
Get onto it.
Got to make it easy for these companies. Beautiful. WAF.
WAF.
What? Stage 3.
Stage 3. So, ding, 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 I am a shareholder of WAF.
Are you, JD? You've been wanting to buy them for a while, haven't you?
I am not.
You haven't pulled the trigger, eh?
I'm a fan. I think I've spoken about it too much to probably a bit conflicted, but I like them.
No, very good. So, again, they sort of previously provided a bit of a production update a couple of weeks ago, but released their quarterly the other day. Another good production result, delivering 51,000 ounces at an all-sustaining of $11.58 US an ounce, which is better than the street expected, and sold 52,000 ounces at an average of around US 2,300 an ounce, all unhedged.
Lovely.
And they do a calendar year sort of process. So the first half production of almost 108,000 ounces at roughly 1,200 US an ounce, all-in sustaining is tracking pretty well to meet or beat their calendar year guidance of a midpoint of 200,000 ounces at less than 1,300 an ounce US. And Sanbrado, all the operating metrics seem to be tracking per or better than the mine plan.
How's Kiaka coming along?
It seems to be going pretty well. So progressing on schedule, on budget. They spent 125 mil Aussie this quarter. Construction's over 50% complete, and over 75% of costs are committed and fixed. They're targeting first gold pretty much almost a year from now, Q3, expecting to produce around 234,000 ounces at almost 1,200 US an ounce over 20 years. So we'll see the production profile go well over 400,000 ounces a year. Kudos to WAF management delivering quarter after quarter, cash and bullion up to 464 mil, and their debt of around 400 mil Aussie is fully drawn. Admittedly, post quarter end, they did release an updated study on Kiaka, which updated the reserve, but also there was a bit of a change to an owner mining strategy. So slight more capex required up front, but for lower OPEX across the life of mine. And they raised Aussie 150 mil in equity to fund that additional or help contribute a decent chunk of that additional capex for that strategy.
That mine life is such a contrast to a lot of the Aussie, Aussie miners that have assets in Australia. It's the mid caps, their peers.
Yeah,
it's you just spoke about Regis. It's night and day when you compare the two. The way the reserves sort of drop away quickly, and how many years you can look into the future and be confident.
Yeah, and I think that's a function of these. I know Sanbrado's, going underground, but when you got these big pits like Kiaka, you can prove up reserves.
Yeah,
so much easier to create a long mine life. But when you got underground mines that are going deeper, it's so hard to. You just got to prove them up gradually.
Yeah,
and most gold mines just operate with 2 years reserves ahead of them forever. And they hopefully keep adding to them.
Yeah,
unless it gets cut off like a wattle dam or something. So, yeah, right. Now, what's next? Stage 4?
Stage 4, Pantoro. So, again, it seems to be the trend. A lot of these companies pre-releasing, they produced around just shy of 21,000 ounces, which was up from last quarter, and at just shy of 2,500 an ounce Aussie, all-in sustaining, which was a little bit less than last quarter. So produced 71,000 ounces for the year. They've been, particularly this quarter, they've been hitting above that Norseman nameplate at the mill of 1.2 million tonnes per annum, which is fantastic. They put through just over 300,000 ounces, 300,000 tonnes, at just shy of 94% recovery. So they ended the quarter with just shy of 104 million Aussie, although they did raise 95 million in May, and with just a US 12.5 million Nabari convertible. So they've made just shy of 7 mil from operations by the time you back out, the capital raising and all that. And they also fully repaid the Nabari loan of around 45 million, and another unhedged producer. And, looking at that graph we talked about earlier, just another high-cost producer that's just been a massive beneficiary of the margin expansion with, rising gold prices, and, they've doubled in value in the equity markets in the last 6 months. And they also previously announced FY25 guidance of around 100,000 ounces at plus minus 10% at all-in sustaining of 1,900 Aussie. Plus minus 10%, which is, pretty big improvement from this year's results. They want to add at least 2 additional underground mines in the next 2 years, increase production above 200,000 ounces and expand and re-enter into sort of some other key mining areas there at Norseman, and a shit ton of drilling, 85 kilometres of underground and surface drilling for FY25.
Bloody hell, 85 Ks. That's a K drill job if I've ever seen one. Yeah, Norseman's classed as the Goldfields.
Goldfields extension.
It's their home ground.
K drill are the Goldfields drillers. You don't do any drilling in the Goldfields unless you run it by K drill first. They're like the mob.
They're like the mob.
They're like the mob in the Goldfields. So that's got their bloody name written all over it.
No, get on to
They
it,
better be
K-drill.
bloody ringing them up.
Get on to Pentoro.
Oh, it's better. Imagine 85,000 metres of drilling, and not all of that's surface. Some of it's underground, but the surface component, imagine that much drilling with the best sample management in the industry. That compounds. So that is a shitload of good sample management.
You just sleep better at night, wouldn't you?
Yeah, give Druber. Druber's email's in the show notes. Give him a bloody buzz, Pantoro. Get onto him, Smells. Go on, hit him up. You won't regret it. GC, stage 5, Catalyst.
Stage 5 and the final stage of the Tour de Goldies.
You always come up with a good name for everything.
Oh, look, it was the only
There's a lot of French inspiration, actually.
Yeah. It was the only creative outlet I had as a banker was project names and that kind of shit. So it's continued on to my next career. It's fantastic.
Oh.
So again, continuing with the pre-reporting trend, Catalyst produced almost 32,000 ounces at 23.38 an ounce Aussie. They only sold 28,000 ounces. This was actually a record production quarter for Plutonic and Henty under Catalyst ownership, and better cost performance at both operations versus the previous quarter. So they produced over 110,000 ounces for the year. They are now also unhedged going forward as well. So they ended June with cash and bullion of 37 mil Aussie. They cleaned up a lot of their debt. Now they've only got 8 mil debt in the form of a 2,220 ounce gold loan.
I think they got to pay that over 6 months, eh? So it's 300 and a bit ounces per month.
Yeah.
They got to deliver into it, so not too bad.
So that should be pretty much all gone by the end of this year. And again, they're just with and one of these other high cost producers that's just 3x'd on the back of this gold price coming up, cleaning up the balance sheet, production going up and all the rest of it. And they want to keep going, so they're looking to bring Plutonic East and Trident online in 25, which is pretty key to them for them to fill their 1.8 million tonne per annum mill at Plutonic, which is currently operating at about a 1.3 million tonne per annum throughput rate. So they're currently watering Plutonic East, and there's grade control drilling and rehab expected to commence this quarter. They released a study on Trident earlier this month, and that'll add another around 37,000 ounces a year for 5 years for 15 mil pre-production capital. So you'd imagine if this trend continues, they should be able to fund that out of free cash flow. Really looks like Plutonic is starting to turn around, and Trident will certainly be a good boost. I still question, and look, Henty has sort of, pleasingly, this is the Tasmanian mine that they've got, has only sort of really become operationally cash flow positive literally for a hot minute. They did buy it 4 years ago. I'm not sure that, given what's now going on at Plutonic, do we really care about this asset anymore? And do we really need this asset anymore?
They got it, yeah. They're just one of them things that just come with the deal, wasn't it? To bloody, secure that whole belt, but you got Henty as well.
Yeah, so it's sort of like I think now that they kind of have turned Henty around in this current gold price environment, they could keep it or they could offload it, get a great price for it, and put all that time and capital they're spending in Tasmania back into way more opportunities, near mine opportunities at Plutonic, or perhaps even inorganic growth opportunities in and around that sort of Murchison area. My opinion is I think that capital and time could be better used there, given how they're going quite well there.
Yeah, and I think they'd be running it. They'd be running it as in terms of management and stuff. It's just that extra place very far away that you have to go to.
Yes,
like to your ops manager and stuff. Like instead of having all your attention at the Plutonic operation, you've got to go over to Henty as well and all that. And if it's not, as you said, if it's just making a bit of money, taking that off the hands would actually
alleviate a lot of time.
Focus so much more on that operation. So
I wonder what it kind of looks like on a, you got the social, that's one aspect, but also a rehab if they do decide to shut it.
Yeah.
I've got no idea, but that is, not something you can ignore.
Oh, no. Someone would want to have a punt on it, wouldn't they?
Maybe.
And this gold price, maybe.
Well done, Ali.
Too hard running mines. It's easier to talk about them.
Yeah, absolutely. So that's
why they all hate me, probably. Whatever.
Whatever. So that brings us to the end of today's tour.
Oh, who got the yellow jersey?
Oh, probably. Probably WAF, I'd say. What as far as cash flow goes. But I mean, Catalyst has definitely won the yellow jersey for share price performance in the last little while.
Yeah, they got the king of the mountains.
King of the mountains.
Right, JD, bloody Sandfire, copper.
All right, I've got a couple to talk about. I'll try and fly through it so we don't
Karoon.
So we don't crack the hour. So Sandfire, copper equivalent production of 37,000 tonnes for the quarter. Most of these prices I'll talk about will be US for Sandfire. So C1 cost of $1.54 per pound at MATSA and Matteo $1.56. So they're both heading in the right direction, 28 and 9% respectively improved. Sort of good on MATSA. Like estimates had been kind of varied. So some people said, hey, that was a bit disappointing. Other people said, hey, that was pretty good. So it leaves you scratching your head a little bit. But regardless, you can see that both are operating at higher throughputs. Matteo is now running at 5.4. They had that expansion to 5.2. They're exceeding that. So that is quite strong. Matty, you got something at the tip of your tongue there, yeah?
It's nothing to do with this.
Alrighty.
Just thinking of the mud.
$63 million on CapEx. Now, that's a bit light on. It makes other numbers look a bit better because some of that just got pushed out to FY 25, and that leads to the net debt number being better than a lot of analysts had expected because CapEx wasn't spent. So they closed the financial year with net debt of about US $400 million, an 18% improvement just on the last quarter. So that's pretty strong. But like I said, there's going to be a bit more CapEx that's just been pushed along a quarter. FY24 EBITDA ended up being US $360 million. And just to highlight how good the last quarter was for base metals, given that we've got copper, a good bit of zinc, silver, lead coming out of these operations, well, MATSA, and a lot of silver sort of coming out at Matteo as well. 1/3 of the earnings came from the last quarter. So that kind of, clearly stood out.
And copper's pulled back a bit too. So if there's a bit of a lift like there,
it's pulled back a lot.
Talk.
Yeah, exactly. A lot of talk, financial talk, operational talk, which I'll get into because MATSA is a high cost operation. So to put things into perspective, roughly 134,000 tonnes copper equivalent was done in the last financial year. They want to notch that up to 154, so 13% increase on the year. But overall, it's not really screaming cheap. And we know copper, pure sort of copper plays as they kind of brand themselves, get valued pretty pricily compared to other miners out there. So EV of $4.4 billion for the company now, bearing in mind I said $360 million US in EBITDA. That's trailing obviously, and it should get a bit better, but not the cheapest sort of company out there, and just trying to wrap my head around MATSA. We spoke about this a long time ago now, but I had to just go back and look at the presentation again. Ali, you just kind of triggered me to look at this again. When they acquired it in, I think, September of 2021, they came out with this presentation. So US $1.865 billion was the price tag. They used cash, big debt, and equity raising. And then a year later, in November, I think 22, that raised a bit more cash to sort of shore up the balance sheet. And they called it a plug-and-play acquisition, which in hindsight makes me laugh a bit, just looking at the numbers. I'll flash up what they kind of pitched it as: 100 to 120,000 tonnes of copper equivalent for FY22. You're kind of expecting, because that's established to be quite good. And Matty, I think you're laughing at the C1. It's a joke. So US 40 to 50 cents, a huge amount. Like I sort of said, copper equivalent is what we're talking about. So they just net off, obviously, the revenues that they get from the zinc, the silver, and the lead. And we're talking about gross C1 costs of circa sort of $3. And, you know, you call it 45 cents in the midpoint there. So you can market it as the lowest quartile on the cost curve asset.
Shows how much you can just wipe your ass with feasibility studies usually.
Oh, it's
just double everything and half the production.
It's ridiculous. And to be fair to MATSA, although I don't love how they report, they do that's not the number they quote on the front of their quarterlies these days. But you know, we're talking about $3 C1, and if you just annualize the cash flow they did in quarter 4, which, like I said, was a strong quarter with good copper prices really helping them out, and then you subtract the mine development and the sustaining capital that they had over FY24, which was sort of $80 million and $35 million respectively. Those numbers were both flat on the previous financial year. You only get $160 million in cash flow for the year. Bearing in mind, you know, 1.86 billion US is a bloody big price tag.
Yeah.
If you want to say it another way, add the TCRCs, the treatment charges, to the C1 costs for FY24, and that means you're producing copper at US $3.40 a pound. And that doesn't leave much to fund everything not included in C1. So exploration, mine development, corporate costs, you know, taxes, and, you know, not to mention, you want to take a profit home after all of that. You're not.
Well, you won't be paying tax if you don't make the profit.
Well, that's a bit of a saving grace, and you can see they just spent $3 million in the last quarter on income tax. That gives you a bit of a rough indication. Obviously, the periods and stuff in which they pay it are a bit sort of skewed, but it's just not looking like a great acquisition, and you're going to need copper to really pick up to make that one look better.
Yeah, but it's just one of those. In terms of the ASX, it's not a pure play copper, but it's pretty bloody close. There's a bit of extra shit as well.
It's the default, right?
Yeah.
100%. All right.
Yeah, right, JD, Karoon.
Karoon.
This is an interesting one.
It is. So
a bit of chat.
Yeah. So quarterly and capital allocation framework / buyback announcement came out. We won't touch on the quarterly. The latter announcement is what really got me excited.
JD, what does Karoon do? I've not followed them.
Karoon, they are an energy producer, have assets off Brazil and in the Gulf of Mexico.
There you go.
So, yeah, reporting obviously in barrels of oil equivalent, but they produce oil and gas, mainly oil.
Thank you for that.
So money miners might remember we had Gabriel from Sandon Capital on about 2 months ago. We interviewed him when we were in Sydney, and he at the time had formed an association with Samuel Terry. They'd teamed up and put their holdings together to sort of say that they're going to vote in line with one another regarding the AGM. And, you know, they've got activist in the name, the activist shareholders, these guys. Now, what they came out with and said was that the short-term incentives are just completely flawed at the company. And they said certain directors, they named 3 specifically, have had a systematic lack of care for shareholders. So they were pretty sort of scathing in their corporate language. And essentially they guided other shareholders to how they are going to vote at the AGM to try and get a bit of change happening at the company. Now, there was some very specific views that Gabriel put forward on our show as well. And, you know, first and foremost, pay a dividend. The reason why, it forces capital discipline. It forces the management of the company to acknowledge that capital is a scarce resource within the business, and that makes you think a bit more about how you're going to allocate that. And, you know, lo and behold, they've actually got an outcome here. The company has come out with a framework. It's taken a long bloody time, but they've come out and
What does it say?
They've said that they are going to deliver annual capital returns to shareholders of 20 to 40% of the underlying net profit after tax of the business, and that's going to be returned via dividends and share buybacks. Now, they've reflected on the money they've earned in FY24, in particular in the last 6 months, and said they're going to launch a US $25 million buyback, which, unlike Metals X, they've actually said this is going to be completed by the 31st of December this year. So they put a final date, and they're just going to get after it and buy back the stock because the directors feel the company is underpriced in the market. So thinking about all of that and then looking at what the share price did today, I've got to say I am pretty surprised. I mean, this has taken forever, but it is exactly what the shareholders wanted. And I'm kind of scratching my head. I mean, it's taken a long time, but it removes a huge question mark about what the company's going to do and whether they're going to ultimately just waste away the money, given that they're highly cash generative assets that the company now holds. So you can see investors got excited on the open. It traded up 5%, but it ended up closing the day down 3%.
Yeah,
so,
right.
There's stupid decisions that I think the management have kind of made. They'd obviously look at it a bit differently, but they signed up US $350 million in debt. That was in junk bonds or high yielding, as they'd call them in the US market, which sort of means they have to spend circa US $40 million a year in interest. But things are still moving in the right direction. And there's, with that interest, some tax benefits that you can get and all of that. But if you just look at the numbers for the next year, Karoon capped at 1.4, you add the net debt, EV of 1.5 billion Aussie. Now, it's not unrealistic to think about 800 million US in revenue in calendar year 25. You're thinking loosely a bit over 10 million barrels in the year, earning a bit under US 80 roughly. And that would ultimately lead to US 500 million in EBITDA, or consensus is for 330 million in free cash flow. US dollars, so 500 million Aussie.
That's amazing.
Yeah, right.
So on the next calendar year's number, you're talking about 2 times EV to EBITDA multiple or 3 times free cash flow.
Wow.
And there's a payout ratio. So take it all with a pinch of salt. I know next to nothing about oil and gas, and you've got to contend with a bit of jurisdiction risk. Like I said, one of the assets is off Brazil, the other's in the Gulf. A lot of, very big companies operate in the Gulf, so I wouldn't call it that risky. But you've also got good shareholders in Samuel Terry and Sandon and others aligned with you. You've got management finally looking like they are listening to shareholders. So, it definitely was enough to sort of pique my interest and want to read into a whole lot more, because that is pretty impressive cash flows that they are going to be churning out.
What's the sustainability of those cash flows long term?
They had a bit of success in the last few months doing a bit more drilling, so they need to prove up a bit more. But there's a few years in this, enough to sort of pay back that market cap that you're buying the stock at.
Yeah, there you
one to look into a bit more.
Yeah, nice. Good digging, JD.
Thank you, mate.
Bloody great to have you, GC. Love your bloody injection.
Weekly injection?
Once a week.
You know who else I love, Matty?
Oh,
Axis Mining Technology.
I love all of them too.
Yep, and the love doesn't stop there. We got mineral mining services.
Bloody love, Josh.
MMS, VRIFY, GetWet Solutions, DSI Underground, Silverstone, CRE Insurance, WA Waterboards, soon to be Australia Waterboards, K-Drill, and while you're at it,
I love Spark Charts.
use Spark.
Use Spark. Hoodaroo, money miners.
Go Australia.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.